Most Americans believe their house is their most important investment. It's not. And that belief, held for decades, is one of the main reasons retirement feels harder than it should. I want to be clear about something before we go any further. I'm not here to tell you not to own a home. Owning a home is almost always better than renting. For stability, for predictability, for peace of mind. What I'm here to challenge is the idea that your home is building your wealth the way an investment does. Because when you run the actual numbers, not the simplified version, the real version, it almost never is. And for people in their 50s and 60s who are counting on home equity as a major part of their retirement plan, that distinction matters enormously. Because if your house is your retirement plan, you may be heading into the most expensive decades of your life with far less than you think. Today, I'm going to show you the math most people never run and what the smartest retirees do differently with real estate. Let's start with the number most people lead with when they talk about their home as an investment. I bought this house for $200,000 in 2005, and it's worth $450,000 today. That's a $250,000 gain. That number feels real. It looks like a return, but it's missing almost everything that matters. Let's actually run it. You bought it $200,000. 20 years later, the house is worth $450,000. That looks like a $250,000 gain, or about 125% over 20 years, which sounds impressive until you break down what you actually paid to get there. Mortgage interest over 20 years on a $180,000 loan at 6%, approximately $154,000. Property taxes at $4,000 a year for 20 years, $80,000. Home insurance at $1,500 a year, $30,000. Maintenance and repairs at 1.5% of home value annually, roughly $63,000. Closing costs when you bought, $6,000. Real estate agent fees when you sell at 5 to 6%, $25,000. Add that up. You spend approximately $358,000 to own a house that gained $250,000 in value. The real return on your investment after 20 years isn't $250,000. It's negative $108,000. Now, before you turn this off, I know what you're thinking. You had to live somewhere. Rent would have cost money too. And you're right. That's exactly the point. Your house is where you live. It's not an investment vehicle. Treating it like one leads to decisions that quietly undermine retirement. The people who do the math almost always reach the same conclusion. The house didn't make them wealthy. What they did while living in it did. Beyond the mortgage and the taxes, there's a second layer of costs that almost nobody includes when they calculate their home's return. And these are the ones that really sting. The opportunity cost. Every dollar you put into a down payment, every extra payment you made toward principal, every renovation you funded, that money had an alternative. It could have been invested. Let's say you put $40,000 down in 2005. If instead that $40,000 had gone into a broad S&P 500 index fund, it would be worth approximately $180,000 today, based on historical returns. Not $40,000, not even $100,000. $180,000. That's not money you lost. It's money that was redirected into a less efficient vehicle. One that required you to live in it, maintain it, pay taxes on it, and eventually sell it to access the equity. The S&P 500 returned roughly 10% annually over the last 20 years. The average home in America appreciated about 4% annually, before costs. After costs, the real return on housing has historically been between 0% and 1% per year above inflation. Robert Shiller, Nobel Prize-winning economist who literally wrote the book on housing prices, found that U.S. home prices, adjusted for inflation, returned just 0.6% per year on average from 1890 to 2012. Not 4%, not 6%. 0.6%. That doesn't make homeownership bad. It makes it housing, a place to live, with some equity that builds slowly over time. That's valuable. But it's not a wealth-building engine the way most Americans treat it. The confusion between "my house went up in value" and "my house built my wealth" is one of the most expensive misunderstandings in personal finance. Here's the part that catches most people by surprise, especially those approaching retirement with significant home equity. Home equity is real, but it's also one of the least liquid, most expensive assets you own, and accessing it has consequences most people don't think through. Option 1. Sell the house. You access the equity, but now you need somewhere to live. If you downsize, you capture some of the difference. But in most markets today, even a significantly smaller home costs a significant amount of money, and you pay agent fees, closing costs, moving expenses, and potentially capital gains taxes on the profit above $250,000 for a single filer or $500,000 for a couple. Option 2. A reverse mortgage. You borrow against the equity while staying in the home. But reverse mortgages come with origination fees, insurance premiums, interest that compounds over time, and strict rules about maintaining the property. They're not inherently bad, but they're expensive, and they significantly reduce what you leave behind. Option 3. A home equity line of credit. You borrow against the equity at a variable rate, which has to be repaid. This only makes sense if you have income to service the debt, which, in retirement, many people don't. The fundamental problem with home equity as a retirement asset: every way you access it either costs you the home, costs you significant fees, or creates debt you have to manage in retirement. Compare that to a brokerage account or a Roth IRA. You log in, you sell. The money is in your account in 3 days. No fees, no agent, no moving truck, no decision about where to live next. Equity isn't wealth until it's liquid, and making home equity liquid is always more complicated and more expensive than people expect. All right? I've spent the last several minutes explaining why your primary residence isn't an investment. Now let me show you when real estate actually works as one. The difference is simple. An investment generates income. Your primary residence doesn't. It consumes it. A rental property, bought correctly, managed efficiently, generates monthly cash flow. A tenant pays your mortgage, your taxes, your insurance, and ideally leaves something in your pocket each month. Meanwhile, the property appreciates, and the IRS gives you a depreciation deduction that can make your taxable income on that rental essentially zero. That's a fundamentally different equation from the house you live in. One is a cost center. The other is an income generator. The wealthiest retirees I've studied don't just own their home. They own income-producing real estate alongside it, properties that pay them monthly, that they can sell without disrupting where they live, and that provide a hedge against inflation because rent goes up as costs go up. Even one rental property, bought in your 40s or early 50s with a 15 or 20-year mortgage, can be paid off by retirement. At that point, the rental income is nearly pure cash flow. No mortgage payment. Just income, a single paid-off rental generating $1,800 a month in net income provides $21,600 a year, the equivalent of having roughly $540,000 in a portfolio following the 4% rule, from one property. The house you live in, where you build your life. The property you rent, where you build your wealth. The distinction is simple. The financial difference is enormous. Most people wait too long to make this distinction. They spend their 40s and 50s pouring money into the house they live in, and arrive at retirement with equity they can't easily access and no income-producing assets to replace their paycheck. So what does this actually look like in practice? Here are the moves I see consistently among retirees who use real estate correctly. Move 1. They right-size early. The smartest retirees don't wait until they're 72 to downsize. They do it in their late 50s or early 60s, while they still have income, while they can qualify for a mortgage if needed, and while they can bank the equity difference and invest it. Downsizing at 62 instead of 72 gives that capital a decade more to compound. Move 2. They separate the home from the retirement plan. They don't count home equity as part of their investable assets when they calculate whether they can retire. They treat it as a backup, something that's there if they need it, not something they're depending on. Move 3. They stop over-investing in the house. Every renovation dollar has an opportunity cost. The kitchen remodel, the deck, the finished basement. These feel like investments, but almost never return full value. The smartest homeowners do necessary maintenance and direct the rest toward accounts that actually compound. Move 4. If they buy rental property, they buy it early. A rental property bought at 48 can be paid off by 63. That's a 15-year payoff that creates a retirement income stream from a property that's also appreciated over that period. Buying a rental at 62 creates debt in retirement, the opposite of what you want. The common thread: they treat their home as a place to live and a store of value, not as their retirement strategy. And they build wealth through vehicles that actually generate income and compound efficiently. Here's what I want you to take away from this. Owning your home is good. It provides stability, predictability, and a forced savings mechanism that works for a lot of people. I'm not against it. What I'm against is the story most Americans tell themselves, that the house is the investment, that the equity is the retirement plan, that appreciation alone will take care of them. Because when you run the real math, the full math, with all the costs included, the house almost never performs the way people think it does. And people who discover that in their early 70s, when they're trying to access equity that's harder to reach than they expected, don't have many good options left. Your house is where you build your life. Your investments are where you build your wealth. The people who retire comfortably never confuse the two. Do you count your home equity as part of your retirement plan? Drop it in the comments. Honestly, I'm curious how many people are relying on it more than they realized, and whether this video changed that number at all. If this gave you something to think about, hit that like button. Subscribe if you want more of this. One video every week. No fluff. Take care of yourselves. See you in the next one.